And now it's time for Development Debates. We dig deeper into some of the questions shaping the future and present of China. Today, we discuss if China's downward trending real estate market will pull down the GDP. China's overheated housing market has finally cooled down this year. Even though many measures have been taken by governments and housing developers, the drop in prices have continued. As a hugely important industry to tax revenues in China, slowing down the real estate market might have a huge influence on the country's economy. The National Statistics Bureau looked at housing prices in 70 major cities in the country. In January, 62 cities were still seeing the prices of new houses increase from the previous month. However, in April, the number declined to 50 cities. And the increasing rate of these cities has declined from 1.2% in January to 0.6% in April. More cities are seeing their housing price declines, especially second-hand houses. From January to April, the price of the country's second-hand housing market has dropped more than 13%. Many cities have housing storage of much larger than the market demand, so that decrease in housing prices might not end in a short period of time. Last year, the real estate market contributed to more than 13.5% of the country's total GDP. Some experts estimated that if the housing market stays in a downtrend, it's very possible that will bring down the country's GDP. Meng Xiangduan, a senior analyst at Shanin Wangguo Securities, does not think the influence of the housing market on GDP can be very big. According to the country's economic input to output ratio in 2007, a 1% decrease in investment in the real estate market was supposed to lead to a 0.2% drop in the country's GDP output. It's not considered as a big influence for Meng. Many Chinese experts expected the real estate input to go down to 14% from 21% the previous year. Meng says that without any government intervention, the country's GDP growth would only decline to 6.6% at most. But the Chinese government has already started saving the market with different intervention policies. Additionally, Meng takes the first quarter's data for example, even though the real estate industry is in a depressing market. China still kept its GDP growth rate at 7.4% in the first quarter. With the support of other industries, it's very difficult for the country's GDP to drop or largely slow down. For instance, in April, the country's export and retail market is seeing improvements, possibly better output than last year. And the government's also investing more in the country's infrastructure. All 3 months in the first quarter are seeing a larger investment growth than the average from last year. With an increase in other industries, Meng thinks the decline in the real estate market might not be able to largely slow down the country's GDP. However, Wang Tao, the Chinese chief economist at UBS, says it will have a large influence on the GDP. She estimates that the continuous decline in the real estate market could become the largest challenge for China's economy in the next 2 years. She gives several reasons. First of all, for the past 10 years, the supply of houses has exceeded the demand, and the housing storage might need years to be bought out. Then, with the downward trend in the real estate market, less investments going to it. Finally, the government support and intervention policies seem to have very limited effects on the market. Apart from that, Wang also says the real estate market is not an isolated industry, which can influence many manufacturing industries in the country. The construction materials are going to see a declining market along with the housing market. As well, Wang mentions there's lots of bank loans in the real estate market. Any big changes in housing prices and house buying policy could lead to tightening of the bank mortgage policies. It could also contribute to less consumption and slower GDP growth. As a result, Wang estimated there's a possibility for a downward trend in real estate affecting GDP growth. She said that it could bring GDP to 5.5% in 2014. There's still huge demand for housing in major cities, but the housing prices are still high for the houses to be bought by the average consumer. It's harder to come by loans than it was before, so less people can try and buy. As prices have finally shifted, people want to wait and see if the prices will go down further. And since housing is a huge part of the GDP, it very likely could affect it.